All right, let's dive into the world of financial indicators today, specifically focusing on the standard pivot points.
Ah, yes, a classic.
It really is. It's a tool that, traders often use to get a quick, actionable read on market movements. For this deep dive, we've pulled together some excellent material. We've got a practical tutorial from TradingView's YouTube channel, and also some in-depth articles, things like understanding pivot points, types and calculations, and understanding and applying a standard pivot points. So our mission here is really to cut through the complexity, give you a fast track to understanding this pretty powerful indicator, how it's calculated, how you can tailor it, and most importantly, how top traders actually put it into practice.
It's important to understand, I think, that whether you're maybe new to technical analysis or, a seasoned pro looking to refine your approach, pivot points offer a remarkably clear, systematic way to interpret price levels.
Hmm.
They're designed to give you valuable, actionable insights without overwhelming you with information. It's really about structuring your view of the market.
So, okay, for those maybe familiar with technical analysis, standard pivot points are probably a staple, but let's quickly recap their fundamental role. They're essentially predictive support and resistance levels, right? And they help gauge overall market direction,
Exactly.
all based purely on price action from a prior trading period, typically the previous day.
That's right. The previous day's data is key.
And the most widely used type is the standard, or sometimes called floor, pivot point. It centers around that P level, the main pivot. Then it projects three resistance levels above it, R1, R2, R3, and three corresponding support levels below S1, S2, S3.
Yeah, and some variations, like traditional and Camarilla, they can even go further, adding R4, R5, S4, and S5.
Right, so more levels possible.
What's crucial here, though, is that these aren't just arbitrary lines on a chart. They really help traders anticipate where price might pause or bounce, or maybe even reverse. Think of them almost like invisible magnetic fields for the price.
Interesting analogy.
So if the market consistently trades above that central P level, it often signals, a bullish bias for today.
And below P.
Below P suggests a bearish bias. It's a powerful visual cue for market sentiment. And importantly, because so many traders recognize and use them, they can actually become a bit of a self-fulfilling prophecy.
Yeah, I've heard that mentioned before.
The more people react to these levels, the stronger their effect can potentially be.
Okay, now let's get into the mechanics of it. How are these levels actually derived? For our listeners, what's the core logic behind the calculations?
Yeah, that's a great question. And the beauty of pivot points really is their simplicity in calculation. Every pivot point is derived from a systematic formula using the previous period's high H, low L, and closing C prices. Now, don't worry, your trading platform does all the heavy lifting, but understanding the core logic, well, it helps you use them better. The central pivot P for the traditional pivots, for example, is simply an average of the previous day's high, low, and close.
So just H plus L plus C divided by 3.
Yeah. Exactly. It's essentially the market's midpoint for that period.
Okay, so to really nail this down, let's maybe consider an example. Say XYZ stock. If it had a previous day's high of 105, low of 95, and close of 100,
Uh-huh.
the central P would be exactly 100, right?
Wow.
105 plus 95 plus 103.
Right on the money.
Then the resistance and support levels, like R1 and S1, they just extend from this P using pretty straightforward arithmetic. We won't list all the specific formulas here. It's probably not great for audio, but you can find the complete breakdown for traditional pivots in our deep dive show notes for your reference.
Good idea.
The important takeaway, though, is that they are purely based on past price action. No complex magic there.
Exactly. And beyond traditional, you'll definitely encounter other types like Fibonacci, Woody, and Camarilla pivots.
Right, those other names pop up.
And each one offers a subtly different lens on market dynamics because they use slightly varied calculations for P and its extensions, the R's and S's. For instance, while Fibonacci's P calculation is the same as traditional, its R1 and S1 use Fibonacci ratios, like 0.382 multiplied by the price range.
Okay, so that's where the Fibonacci part comes in.
Precisely. And a key insight I think that many overlook is that while traditional pivots aim for sort of a broad market sentiment gauge, types like Camarilla are specifically engineered for more aggressive mean reversion type strategies. They offer tighter support and resistance levels.
So Camarilla might be better for range-bound markets, maybe?
Potentially, yes, or for quicker scalping moves. The choice isn't just aesthetic, it's really a strategic alignment to your trading philosophy and the market conditions you're seeing.
That's fascinating. Okay, so once you have these pivot points actually plotted on your chart, how do you make them work best for you? The settings menu seems key here.
Absolutely.
Okay.
That's where you customize.
One of the first things you'll notice is that typesetting, which lets you choose between those different calculation methods we just touched on: traditional, Fibonacci, Woody, Camarilla, and so on.
Hmm.
Then there's pivot's time frame. By default, it's often set to auto, which is pretty clever. It adjusts based on your chart resolution. So like if you're looking at a 15-minute chart, it usually shows the daily pivots.
Right.
But if you zoom out to a daily chart, it might automatically switch to, say, monthly pivot.
Makes sense. It adapts the context.
Yeah, but you can manually set it too. Daily, weekly, monthly, or even yearly pivots. But it's worth noting, right, that pivot points are most frequently applied and observed at the daily level. That's what the pros tend to focus on.
That's generally true, yes. Daily pivots are very widely watched by professional traders and risk managers. That daily level often sets the tone. And this leads us to a really critical, but sometimes misunderstood, setting. Use daily-based values.
Okay, explain that one.
Well, think of it like this. Are you calculating yesterday based on just the standard trading session hours like 9:30 to 4:00 Eastern for U.S. stocks? Or do you want to include all the extended market activity, the pre-market, and after hours?
Ah, right, because sometimes a lot happens outside the main session.
Exactly, especially for certain markets or specific stocks.
Yeah.
So turning this setting off tells the indicator to construct its pivot levels using all the data your chart is currently displaying, including extended hours if your chart shows them.
So it uses the high, low, close from the full period shown on the chart, not just the standard session.
Precisely. This can be crucial for things like futures contracts, which trade nearly 24 hours, or stocks like Apple or Tesla that have significant pre-market or after-hours moves. It means your higher time frame data, like weekly pivots, will be built from the actual intraday data you're viewing, potentially giving you different, sometimes more relevant levels.
Okay, that's a subtle but important distinction depending on what you're trading.
Very much so.
And then, of course, for visual preference, you have all the standard chart customization options, whether to show the labels like R1 or S1, display their actual price values, adjust the line width, or pick colors, like maybe making support lines green and resistance lines red for quick visual cues.
Standard charting stuff, yeah. Makes it easier to read quickly.
You can even choose to only see the price levels without the actual lines if you prefer a cleaner look, or decide on which specific time intervals the indicator is even visible. Like maybe you only want to see daily pivots on your hourly chart, but not on your weekly chart.
Right, filtering visibility.
And you can also control the number of pivots back, how much historical data you want to see. Display more or less historical pivot levels up to, I think, 500 lines back on some platforms.
Yeah, gives you historical context for how price reacted previously.
Okay, so putting it all together, what does this mean for someone actually using these? How do traders typically apply pivot points in their day-to-day strategies? It seems like it's really about, well, identifying market bias first, right?
That's usually the starting point.
If the price consistently stays above that central P level, it signals a bullish market bias for the period. If it's below, it's bearish. Simple as that.
Exactly. It gives you an immediate directional feel.
Yeah.
And beyond bias, they also serve as fantastic potential entry and exit zones.
Okay, how so?
Well, traders might consider looking for long entries near support levels, S1 or S2, especially if the overall trend is up. Or, conversely, look for short entries near resistance levels, R1 or R2, in a downtrend.
Makes sense. Buy near support, sell near resistance.
Correct. And often, the next pivot level becomes a logical first take-profit target. Enter long near S1, maybe target P or R1. I've seen traders, myself included back in the day, who've gotten greedy.
Yeah.
They ignore that R2 or S2 target, thinking it'll go further, only to watch the price whip right back down.
Yeah.
It's a classic mistake. Sometimes the simplest cues, like these predetermined levels, are the most powerful if you respect them.
Right. Discipline is key. Don't fight the levels without good reason.
Precisely. And for breakouts and reversals, you watch for momentum. A decisive break above R1 with strong volume or momentum could signal a likely move up towards R2. But a failure at R1, maybe price hits it and immediately reverses down, well, that might indicate a move back towards P or even S1.
So it's about observing the reaction at the level, not just the level itself.
Absolutely. Price action context is crucial.
That's a painful lesson, I'm sure, watching a win turn into a loss by ignoring a pivot level. So it's not just about drawing the lines, but trusting them and understanding how price interacts. And what about using pivot points with other indicators? You mentioned confluence earlier.
Yes, and that's where the real edge often comes in. While pivot points are definitely valuable on their own, their effectiveness, their reliability, significantly increases when used in confluence with other technical tools.
Okay, so what does confluence mean in this context?
It means looking for situations where a pivot level lines up with something else on your chart. Maybe an S1 level also coincides with a major trend line that's been respected before, or perhaps a key moving average like the 50-day or 200-day.
Ah, so multiple reasons for support or resistance at the same price area?
Exactly. If S1 lines up with the 200-day moving average, that support level becomes much stronger, much more significant in traders' minds. Also, higher time frame pivot points, like weekly or monthly pivots plotted on a daily chart, can provide even stronger support or resistance zones. They can act as a crucial confirmation for signals you might see on the daily pivots.
So a daily R1 might be resistance, but if the weekly R1 is right there too, that's a much bigger hurdle for price.
Precisely. It's all about building a robust picture, not relying on just a single data point. It's about stacking probabilities in your favor, finding those areas where multiple signals align.
Makes sense. Increase your odds. Now, as with any tool, pivot points aren't perfect, right? They must have their strengths and weaknesses. On the pro side, they seem relatively simple to calculate and visualize on a chart. That's a big plus.
Definitely. Ease of use is high.
And they are also, as we discussed, very widely recognized, which, as you said, can make them somewhat self-fulfilling prophecies in the market if everyone's watching them.
They tend to react to them.
Plus, they seem applicable across various markets, stocks, futures, Forex, and they really help in setting clear risk and reward levels for trades. You know, stop below S1, target R1, that sort of thing.
Those are all solid advantages, yes.
Mm.
But looking at the flip side, the cons are equally important to consider. You need to be aware of the limitations.
Okay, what are the main drawbacks?
Well, because they are static levels calculated at the start of a period, like the start of the day, they can become stale pretty quickly in highly volatile markets. News hits, the market rips, and yesterday's levels might suddenly seem irrelevant.
Right, they don't adapt in real time to sudden shifts.
Exactly. This presents a challenge. They can also produce false signals in choppy or sideways markets, where prices aren't trending cleanly but just sort of bouncing around between levels without clear direction. You might get whipsawed, buying S1 and selling R1 repeatedly.
Yeah, range-bound chop can be tough for any breakout trend system.
It can. They don't inherently adapt to changing volatility without you maybe manually adjusting your approach or pairing them with another tool, like an average true range indicator perhaps. So while powerful, pivot points are generally best used, as we discussed, in conjunction with other indicators or pure price action analysis for higher probability signals. A good analogy might be using a compass. It reliably tells you which way is north, but you still need a map, maybe current weather conditions, perhaps a GPS for the full picture of your journey. Pivots give you key levels, but not the whole story.
That's a great way to put it. Okay, so to wrap up our deep dive into standard pivot points today, let's recap the key takeaways. The central pivot point, PA, acts as the market's sort of center of gravity for the period.
Good summary term for it.
Levels like R1 and S1 are kind of your first line of defense or attack, while R2, S2, and especially R3, S3 represent stronger, more significant levels where bigger reactions might occur.
The further out, generally the more significant.
And the general rule seems to be, try to trade with the pivot-defined bias look for longs above P, shorts below P, and definitely respect these levels for strategic entries, exits, and, crucially, for setting your stop losses.
Absolutely crucial. And critically, always strive for that confluence we talked about. Combine pivot points with other indicators you trust. Observe the price action closely at these levels. Look for confirmation. That's how you find higher probability signals. So this leaves us with an interesting question, perhaps, for you, the listener, to ponder. In a world of increasingly dynamic, sometimes chaotic, complex markets, how might incorporating a structured yet adaptable tool like the standard pivot points indicator refine your approach to understanding market levels and potential turning points? And perhaps just as importantly, what other tools or information might you explore to further complement this knowledge and build a more complete trading framework?